Artificial intelligence technology has already begun to transform the global economy, and that momentous shift is showing no signs of slowing. Most recently, investors have been laser focused on AI's potential to alter the foundations of certain industries, from software to insurance to shipping and beyond. After a deep dive into the impact of AI across technology and technology adjacent sectors, Morningstar's equity research team just made a series of major changes to their assessment of economic moats for more than 36 major companies. I'm here with Eric Compton, Director of Equity Research for Technology for Morningstar Research Services, who will take us behind the curtain of the review process and the results it yielded. Thanks so much for being here, Eric.
Thanks for having me.
So first, let's lay out some background for our viewers. How does an economic moat fit into Morningstar's approach to valuing companies?
Of course. So economic moat's a core fundamental part of our process as we're trying to evaluate the competitive sustainability of companies, which also impacts how we value them. And so just a really quick overview, we've got our 5 moat sources: switching costs, intangible assets, efficient scale, network effects, and cost advantages. And so we look for these patterns in companies as we evaluate their competitive positioning. And generally, just to kind of cut through a lot of the details, but you can think about the longer the duration of expected competitive advantage, the longer the duration we expect companies to earn excess economic returns, which we define as return on invested capital relative to weighted average cost of capital. And so companies that have narrow or wide moats will have a longer duration of higher returns, and therefore, all else equal, you would expect them to have a higher fair value estimate. And so a key part of our methodology is really trying to get that moat call right, and that helps us value companies over the long term.
So speaking of the long term and how it might change, how does AI change the picture when it comes to traditional economic moats? And I'd love if you could talk a little about how our analysts kind of have wrapped their heads around a new technology like this, which is changing really quickly and has kind of an unpredictable future.
Of course. So AI, it is a big deal. So we think it does potentially change a lot. And so we wanted to make sure we were taking a large change in a technology paradigm seriously and factoring that into our moat ratings. The first thing I would emphasize is that our fundamental moat methodology has not changed. We're still using the same moat sources. We're still trying to look at companies in the same way. It was more just about factoring AI into how we think about threats or advantages to those different moat sources for specific companies over time. And as we've gone through that process, how have analysts been wrapping their heads around that? We came up with an internal framework of how AI might change things, what this new technology paradigm might mean. And then we tried to factor that into, on an individual company basis, is this company's switching costs, are they improving or getting weaker? Are they going to be sustainable over the next 10 to 20 years? Things like that. And so really switching costs was a big one that came up a lot, and also intangible assets. You can think of AI, for example, fundamentally lowers the cost of producing code. And so if part of the value of your firm was the intangible assets of your code base, recreating that might become easier in the future than it was in the past. And so it was one thing we were looking at.
Great. And I imagine there might have been some debate as part of this process. I imagine, AI is so new and there's a lot of opinions. Can you give us a little peek about, what the process was like and what the conversations were like behind the scenes?
Of course. So as you said, a lot of debate around AI. I think if any of our viewers have been online at all or in markets at all over the last month, you've been exposed to a lot of these debates. So definitely a lot of debate. There was a lot of back and forth behind the scenes, which was healthy. We want to have healthy debate to try to make sure we're getting to the best prediction of the future that we can get to. And so, a couple things that we debated pretty heavily and that came up quite a bit around these companies was, one, changing the cost of producing code, like how does that affect these companies? Is the fundamental value add of certain companies, is it purely the code base, in which case it can be recreated, or are there other things at play? Other things at play could include, and I'll use kind of software companies as an example here. A lot of the value they add can go far beyond the code, and that can include unique data assets. It could include the domain expertise. So you're creating potentially complex workflows that require a lot of very specific domain expertise, like, for example, semiconductor design. There's just a lot of stuff in there that may not be, that an LLM wouldn't necessarily know. It can also be a core competency of software firms is distribution and performing a competent sales motion. And so even if you have a good model, it's not always easy to get end clients to adopt that. And a lot of the existing software firms already own large distribution networks, which can be an advantage for them. So those are a lot of things we looked at. Network effects also came up a lot. That was one where we felt wasn't really impacted as much by AI. Switching costs came up quite a bit as well. Does AI allow more automated switching between vendors? Whereas in the past, maybe it was more difficult because you had a lot of data links and like other interconnects behind the scenes that maybe you can automate a bit more. So all of those items came up in these internal discussions.
Yeah, it's interesting. I'm going to ask you about results in just a second, but before we get there, this is kind of, it seems to me like these are the questions that, as we've seen kind of rolling sell-offs in the market, these are the same questions that, investors are grappling with too, as we try, as everyone tries to wrap their heads around, what does AI mean for the future of all of these industries? Does that feel like kind of a fair comparison?
Absolutely. And I think one of the key takeaways is just that I think undeniably, we can debate who the future winners and losers are, and there's a lot of room to debate there. But I think undeniably, we can say that predicting those winners and losers has become harder, and uncertainty has increased. And that was one of the key drivers of this, was to try to sort through that. And when you think about our moat ratings, narrow moat, we have to have a high degree of confidence in the return profile over the next decade. And for wide moats, it's over 10 to 20 years. When uncertainty increases because of a changing technology paradigm, it does get harder to have confidence in the return streams that far out. And so that was, I think, undeniably, that was a key theme.
Great. Okay, so let's talk about what you found. Our analysts looked at more than 100 companies. Broadly, can you give us a sense of what the changes that came out of the review looked like? Mostly upgrades, downgrades? How did they impact, our fair value estimates, uncertainty ratings? What's the top line before we drill down into specifics?
Yep. So we had roughly, I think it was 132 companies that we reviewed as part of this process. So it was quite the undertaking. When we came out of it, we did downgrade a number of firms. Of those 132, 18 of the companies were already rated as no moat. And so we just maintained all of those companies. Probably not too surprisingly, we maintained them at no moat. There were a couple companies that analysts wanted to upgrade because they thought they were beneficiaries of higher infrastructure demand driven by AI. None of those upgrades went through, so all the nones remained at none. For the narrow moat firms, we downgraded roughly 30% of the narrow moat firms that we reviewed, and we downgraded roughly 30% of the wide moat firms and 40% of the narrow moat firms we downgraded. And so if you look at an absolute number basis, roughly 40 firms were downgraded as a part of this process. It was there were a number of changes. Most of the changes were a one-step downgrade. So you can think of a narrow moat going to none or a wide moat going to narrow. There were 2 firms that were downgraded, a double downgrade from wide to none. So that was pretty rare. Most of them were single-stage downgrades.
Okay. So what I'm hearing is, AI is kind of putting pressure and reducing, competitive advantage across companies for those firms that were wide or narrow for the most part. Is that a fair assessment?
Exactly. And the reasons for a lot of those downgrades, I mean, there are nuances on the individual company level, but just at a high level, for a lot of software firms, there are some app layer economics in there. And so we did feel the app layer was a little more under threat. Infrastructure layer, maybe not quite as much under the same threat as the app layer.
Could you give us the distinction between, what company has an app layer that you feel good about and what company are good or downgrading, and then where are we on the infrastructure layer, just to give specifics?
Absolutely. So think of like app layer economics. It's something where you've got just like one of the main value adds is just the user interface. So maybe behind the scenes, like the data or what you're doing isn't super complex, but it's more getting that into a slick user interface that humans are like to use and helps them improve productivity. And so something along those lines would be like a lot of CRM software or something that maybe viewers are familiar with would be something like Workday, where or even like payroll firms. So like an example workflow might be like talent management, where you need to track like a job posting, how many people have applied, sort the resumes, move them through the interview process, keep track of which ones you're declining, which ones you're potentially accepting, keep track if you've done the job offer, if they've accepted. So all of those processes aren't really, I would say, that complex on the surface. And it's more about just having a structured UI that helps guide people through the process. And so something like that we would view as a little easier to recreate and a little more under threat versus at the infrastructure layer. A good example of that would be something like cybersecurity firms, where you are really part of, even something like Cloudflare, where you're part of like the infrastructure of the internet. And so that's one aspect of it. There were a couple other things that went positively for cyber firms, including we think AI is going to actually increase demand for their services, but that would be an example of you're like running processes on top of these platforms. And so you're really more part of the infrastructure, and usage should actually probably even go up, even if you have AI agents, for example, completing tasks.
I see. Makes sense. Were there any major kind of downgrades? I know you mentioned two that were two-step, but any major firms that we downgraded that stand out that are worth mentioning?
Yeah, a couple of patterns on the downgrades. So this may not surprise some people, but the downgrades were largely concentrated in enterprise software and IT services. So enterprise software, a couple examples there, like Adobe, we downgraded from wide to narrow. Some of the more like CRM, ERP style software firms like Salesforce or Workday, we downgraded from wide to narrow. The payroll firms also saw some downgrades. So like ADP went from wide to narrow. And a couple themes in there. One is the app layer economics. I think another one to call out would just be the seat pricing dynamics. And so a lot of those business models really do price per a seat or per a user. Or in the case of payroll firms, like per an employee. And so as one of the things that AI potentially threatens is as workflows become more efficient or more automated, or you see changes in just the structure of the workforce, the number of seats could go down, and that does threaten the return profile. And so it's just, we felt it was harder to predict over the next decade plus what the seat structure and the pricing structure around that might look like. And so those are a couple patterns around those particular sectors that were a little more concentrated with the downgrades.
Great. And then I wonder if you can walk us through the process for maybe one company. How we came to a decision to adjust our Moat rating, what we took into account, what the analysts talked about, walk us through it so we know what it looked like.
Sure. So the process was essentially similar to our general Moat committee meeting process, which we do for all companies when we go through a Moat rating update. We just we did it for a large number that we thought potentially could be threatened by AI all at once. And so the process for that is an analyst writes up a pitch around their company. In this case, we implemented a specific AI framework. So we came up with a number of key vectors that we thought AI was relevant for. We covered a lot of those already, actually, app layer versus infrastructure layer, seat-based pricing dynamics. Is your model seat-based? Does AI increase or decrease demand for your product? Things like that. And so we had a number of those key vectors that we wanted each analyst to analyze for each of their companies. They put together a pitch. They submit it to the committee. The committee is comprised of a group of more senior analysts who we think are best positioned to vote on the moats of these companies. And then there's a live debate. The committee voters read through the pitch, and then you have the analyst in the meeting. You debate the name, and then the voters cast their votes. And so that's the process. For a specific company, like arguments around that, I'll give you maybe two examples. So one would be
Great.
on the EDA firms. And so EDA, an EDA firm, for those who aren't familiar, the two main players there are Synopsys and Cadence. These are semiconductor design software solutions. And so you can think of
right in the center of AI, of the AI trade right now.
Exactly. And so you're kind of already foreshadowing, these companies scored pretty well on our AI threat matrix. And so, yes, they are software, but a couple of things we really liked about how the EDA firms are positioned is one, we think AI is going to increase demand for these products. And so if you think about just as AI proliferates across the economy, you're going to need more chips to power that AI. Those chips are only going to get more numerous and complex over time. You can also think about the physical AI build out that's likely coming. And so you're going to need new chips for those applications. So you're just going to get even more demand for designing new chips to power AI in the future. So we think AI is a positive demand vector for these companies. We find the workflows to be extremely complex. We think semiconductor design is potentially even the most complex vertical software workflow in existence. And so we think that's going to be harder to just recreate, either for competitors or for startups. There's a couple other more technical factors, such as EDA firms have to get their design workflows integrated with and approved by the fabs. And so you can think about if you want to design a chip and then have TSMC manufacture it, TSMC has to be a part of that process. And so there's things beyond even just the code. You have to coordinate across multiple players in the industry. And then I think so. We really like how those firms are positioned. One that we downgraded was in the payroll space. We downgraded ADP and Paychex, both from wide to narrow. And a couple of the things that So I'll start maybe on the positives. So there certainly are some complexities in the workflows that they provide. One example would be you don't have room for error on like not paying your employees, right?
Right.
So there's you could say it's mission critical, zero room for error. There are complexities to the payroll process. You have to coordinate tax code across numerous jurisdictions, both domestically and internationally. So there are complexities there. You don't want to like break the law and not follow the appropriate tax code as a company. So there certainly are positives. However, things that worried us a bit more for those firms that led us to the downgrade from wide to narrow would be largely around some of the app layer economics. And so some of the offerings for these firms are like the talent management workflow that I talked about before, where maybe the task code is complex, but certain parts, certain modules, certain parts of the offerings aren't as complex. So that they seemed a little more potentially value disruptive in an AI world. We also didn't love the seat-based dynamics where the employee, they charge per an employee. And so I think one of two things could happen. You could just have a net decrease in total employees, which would be a negative for their pricing, or you could have maybe a shift in the workforce. And so you could think of maybe if incumbent firms more broadly are disrupted and you have new firms coming out that are more AI native, those are going to be new firms that now have to make the choice. Do we use ADP and Paychex or do we go a different route? And so they're going to have to win new business at a high velocity. They kind of have to run in place to stand still, so to speak. So
I see.
Yeah, the seat-based dynamics were a little worrying there. Some of the lower complexity workflows. And so those, we lost confidence in that 10 to 20 year outlook. Still feel good about the 0 to 10 year outlook. And so downgraded those to narrow.
Great. But over the long term, it sounds like they might be a little more vulnerable.
Exactly. And these are all probabilistic bets, right? And so we could enter a scenario where maybe, and I think this is another key point is, we're we're highlighting that it is harder to sort the winners and losers, but it doesn't mean there won't be winners among the incumbents, even among the downgraded firms. It's just harder for us to tell right now. And so you could definitely, I could imagine a scenario where these incumbents, they have a right to win because they own the current customer base. They've got distribution advantages. They do have a current engineering workforce that is trying to implement AI into their products. And so they could certainly, quote unquote, figure it out over the next several years. And if they do figure it out and turn AI into a tailwind instead of a headwind, there certainly could be winners in the incumbents. And so it's something to watch for. Again, we're kind of dealing in probabilities here, 10 to 20 years out, but these firms still could certainly do well over in the future.
Makes sense. Yeah, that actually is kind of a good segue into the next thing I want to ask you about, which is, you mentioned cybersecurity earlier, but I wondered if there's any other sector or notable company that retained a wide moat that you think, is worth saying, we think this incumbent does have the competitive advantage, even when it comes to AI.
Sure. So I think you hit on a lot of the key ones already. Cyber was a big one. That was probably one of the more attractive sectors. EDA firms I already covered, and you could even put that into just a broader classification of, I'll call them like highly complex vertical SaaS workflows. So EDA firms is a good example of that. There's also other design firms out there like Autodesk. There's a couple others as well, but so design firms maintained pretty well. Cybersecurity, complex vertical SaaS. I think another key, this isn't really sector, but another key trend we saw was that network effects we felt would be pretty immune to AI disruption, because the moat there isn't really based per se on the technology. It's based around the network. And so
could I ask you to back up and just give us an overview of a network effect and what that means and how you measure it?
Absolutely. So think of a network effect like something where I'd say, these business models often tend to be winner take all or most dynamics, because as the network gets larger, it strengthens. And you can think of a network effect as the network gets stronger, the more users join. There's often like also two-sided network effects. You think of that as like a marketplace. So one example would be, and actually this is a good one to call out because this is a more controversial name, would be Booking. And so Booking, like a travel network, you can think of it gets more valuable for the travelers the more supply. Think of like hotels that you have on the network, because then you can find a hotel wherever you're trying to travel to. And it also becomes more valuable for the hotels the more travelers go there, because you're more likely to find someone that wants to book with you. And so that's not really like a technology mode. It's about the network. And so regardless of AI, it's still very attractive to be a hotel or be a traveler on those networks. Now, there are also technology dynamics. Another thing we liked about the Booking model was they've done a really good job of, I'll call it, aggregating the long tail of supply. And what I mean by that is you have a lot of small boutique hotels across the world that maybe aren't the most tech savvy, and it's hard to get them on a network. And so there's a lot of technological work and just manual work to get all of them to sign up for and integrate it into your network. And I don't think AI is going to fundamentally change that. I don't think AI makes the like the boutique hotel in Italy that has 3 people that run it. It doesn't make them more likely to join a different network, for example. So that would be an example of a network effect, and one where we thought, even though on the surface there's a theory out there that like AI, you'll have AI agents just booking travel for people, and they'll just do direct bookings with a lot of these providers. When we actually look at the numbers, most of the volume on a network like Booking is actually for these boutique providers that are harder to get to be part of your network, not to mention just the difficulty of disrupting the network in the first place.
I see. So the strength of that network can actually insulate you against some of the risk, depending on the specifics of the business model.
Exactly. Another example would be the stock exchanges. And so we looked at the European stock exchanges and also ICE. And that's another one where like you trade on the exchange because of the deep liquidity pools and the network it provides. And we don't see that changing.
Great. So there's like so much more in here, and I know there's about 120 more companies I could ask you about, but I'll stop us and I'll ask you to maybe zoom out again. Wrap us up. As you think about the review, you think about the landscape for AI going forward. What's the most important thing for investors to keep in mind about the landscape for stocks, about the stocks we cover, about their investments in the future? What's the takeaway here?
So I would sum it up as AI is certainly increasing uncertainty. We don't buy into the thesis that AI is just going to destroy everything. We think AI is, you have to try to sort things appropriately. You have to try to sift through the winners and losers. We don't think every incumbent's going to be a loser. And we covered a lot of the frameworks and concepts we use to try to sort through those. So that would be one thing. Another thing I would highlight is just the difference between a moat rating and valuation. And so a lot of the companies that even the ones that we downgraded, we still think a lot of them are undervalued. And so we think that the market may be overreacting to the risks. Even though some of the risks are real, you still have to price that appropriately. And so there are cases where we think, for example, in some of these enterprise software firms where we downgraded them from wide to narrow, but we still see a big gap between our fair value estimate and the market. And that's even after downgrading some of the fair value estimates as well. And so we think use AI, think of it more as a sorting mechanism, not as a destroyer of everything, and then try to separate moat rating and valuation. And we think there's still opportunities for firms that have some threat, but maybe where it's priced in a little too severely.
See, makes sense. Well, Eric, thank you so much for being here. This has been such an interesting conversation, and plenty to watch in the weeks, months, and I guess years ahead on AI. Great to have you here.
Absolutely.